Market crashes 25% in a matter of weeks. Your friends are panicking, selling everything, swearing off stocks forever. Headlines scream, recession confirmed, the end is near, worst drop since 2008. Meanwhile, quietly, a small group of investors is doing the exact opposite. They are buying aggressively, methodically, without emotion. When the market recovers, which it always does, they are sitting on double or triple their money while everyone else is still trying to break even. This is not luck. This is not timing the bottom. This is a deliberate strategy called buy the dip. And when done right, it is one of the most powerful ways regular people can build serious wealth during market chaos. In 2026, crashes are not rare events, they are inevitable. AI bubbles, interest rate surprises, geopolitical shocks, earnings misses, something will trigger the next one. The question is not whether it will happen, the question is whether you will be the one panicking or the one quietly getting richer. Today, I'm giving you the complete by the deep playbook, step by step, no hype, no gambling. Why it really means, why it works, the exact mistakes that wipe people out, how to prepare right now so you are ready when the next tip arrives, and a simple 2026 checklist to make sure you are positioned to win. If you have ever watched your portfolio drop and felt helpless, this is the video that changes that. Stay until the end. I'm giving you the exact rules and triggers I personally uses so you can act with confidence instead of fear. Let's break it down. First, what buy the dip actually means. It is not blindly buying every time the market falls 5%. It is not YOLOing your entire account on a single stock. It is a disciplined, long-term strategy of adding to high-quality investments when they become temporarily cheaper due to market overreactions, fear, or external shocks, while your thesis about their long-term value remains unchanged. The core philosophy comes from Warren Buffett's famous line, "Be fearful when others are greedy, and greedy when others are fearful." In practice, it means owning more of what you already believe in what is on sale. Why does it work? Because markets are emotional in the short term but rational in the long term. Even major crash in history like 1929, 1973 or 74, 1987, 2000, 2002, 2008, 2009, 2020, 2022 was followed by the new all-time highs. The S&P 500 has delivered about 10% annualized returns since 1926, including every crash. Dips are temporary discounts on the long-term upward trends of human progress, innovation, and compounding. But most people lose money during dips because they do three things wrong. 1. They sell at the bottom to stop the bleeding, locking in permanent losses. Number 2. They wait for the perfect bottom that never comes, missing the entire recovery. Number 3. They buy too early with money they can't afford to lose, then panic sell when it drops further. The winning playbook avoids all three. Step 1. Build your dry powder before the crash. You need cash or cash equivalents ready to deploy. Rule of thumb. Keep 10 to 30% of your investable net worth in high yield savings or short term trades earning 4 to 5% APY in 2026. This is not your emergency fund that stays separate at 6 to 12 months of expenses. This is your opportunity fund, money you are emotionally and financially okay putting to work when prices fall 20% or more. Step number 2. Know exactly what you will buy. Create a pre-written watch list now while calm. Focus on high quality, low cost, diversified assets with strong long-term fundamentals. Examples in 2026. VTI or VO for pro-US markets exposures, VXS for international diversification, QQQ or VUG for tech or AI growth, VNQ or SEHH for real estate, individuals blue chips. If you research deeply, Apple, Microsoft, Nvidia, Visa, etc. Write down triggers prices on percentages, 20% of all-time highs, 30%, 40%. When the market hits those levels, you already know what to buy and in what size. Step number 3. Use systematic buying rules, not emotion. Never go all in one day, one of a dip. Use dollars cost averaging on steroids. Invest fixed amounts at set intervals or price levels. For example, commit to buying $1,000 every time the S&P 500 drops another 5% up to a total of $10,000, or later buys 25% at 20% down, 25% at 30% down, etc. Automate where possible. Many brokerage let you set recurring buys or alerts. Step number 4. Rebalance ruthlessly. When stocks crash, your portfolio allocation drifts, cash or bonds become a bigger percentage. Rebalancing forces you to sell what held, buy what fell, literally buy low, sell high. Do it when allocations shift 10 to 15% or quarterly during big moves. Step number 5. Protect yourself from the three biggest killers. Number 1. Never invest emergency money or money you need in the next 5 years. Number 2. Avoid margins or leverage during volatility. You can get margin called at the worst moment. 3. Don't chase falling knives. Stick to your pre-written list of quality assets, not meme stocks or unproven names. Quick 2026 by the deep readiness checklist. Number 1. Do you have an emergency fund of 6 to 12 months in high yield savings? Number 2. Do you have a separate opportunity fund of 10 to 30% of investable assets? Number 3. Do you have a written watch list with triggers prices or percentages? Number 4. Are your recurring investments set up to buy more on dips? Number 5. Is your portfolio diversified and rebalance ready? Number 6. Have you mentally rehearsed staying calm during a 20 to 40% drop? Crashes are not the enemy, they are the biggest wealth transfer events in history. They transfer money from the impatient and emotional to the prepared and disciplined. The next tip is not coming to punish you, it is coming to reward you. If they change how you see market drops, hit like, subscribe, and comment. How much opportunity cash do you have ready right now, and what is the first assets on your buy the dip list? I did everyone. Thanks for watching. The next crash is not a disaster, it is your invitation to get richer. Be ready. See you next time.